business cycle. We'll talk about what the test are. You're not going to be tormented too much on economic indicators. You will be tested on two leading economic indicators I'm going to share with you. And you're going to be tested on types of industries and then balance sheet and income statements. This can be a challenging part of the test indeed. So our first test question is the definition of a recession. I, Gabriel, like what Will Rogers said. Will Rogers said a recession is when your neighbor's out of work. A depression is when you're out of work. And so they're going to say a recession can best be characterized as aim and shoot, point, click. You would say 2 calendar quarters of declining GDP. A depression would be 6 calendar quarters of declining GDP. That's our next test question. What is gross domestic product? Gross domestic product test question is the total goods and services an economy produces. You know, nobody has more GDP than the United States economy. The US economy produces more products and services than any other economy. China's number 2, Germany is number 3, Japan 4, you know, who cares? California, I think it's like 5. Now, as I said, we want to know where we're going. The most important thing in the business cycle is not where we're at, not where we've been, but where we're actually going. And I said there's 2 leading economic indicators you get tested on, and those are stock prices. You know, the stock market is all about earnings or future expectations of earnings, and the stock market is best represented by the S&P 500. So
earnings
stock
or
market
expectation of earnings,
yeah,
is one of the 2
one of the economics. I said there's 2 you're going to be tested.
Earnings and expectation of earnings are 1 point.
Yeah, it's about earnings or the stock market is about earnings or future expectations of earnings. And so, you know, when we're doing what is called fundamental analysis, we're either going to be doing top down. That's what we're doing right now, because we're starting this discussion by talking about the economy, top down, then the industry, then the stock. If I would have put up a slide with a balance sheet of a company, then we'd be doing bottom up. We'd start with the company, then we would look at the industry, and then we would look at the economy. So we have 2 versions of fundamental analysis. We have top down, economy, industry, stock, or bottom up, stock, industry, economy. I always think when I think of fundamental analysis, I always think of Mr. Buffett. You know, Mr. Buffett makes a decision about an industry or economy, then an industry, and then buys, you know, a stock. Like he's thinking, okay, the US economy is going to do well. If that's true, then transportation companies should do well, so I should buy a railroad. You know, if I'm right about the economy and the economy is going to do well, people are going to need energy, fuel, I should buy an oil company. That's top-down analysis.
And that was economy, industry, stock.
That's right.
Okay.
Now, the consumer price index is used to measure inflation. You know, what it is a price of a basket of goods and services in a particular city, and it is used to measure inflation. You know, too much money chasing too few goods is bad. Too much money. Too many goods and not enough money, that's bad. So we don't want to have too much money in the economy or too little money in the economy. What we want to have is price stability. Who's in charge of price stability? Making sure there's not too much money in the economy, too little money in the economy. Who's in charge of the money supply?
Federal Reserve.
Right on. And I always joke, if you want to sound like you know what you're talking about, somebody asks you about economics, finance, or investments, you say it has a lot to do with interest rates.
Remember that from your videos.
And if you shut up, you sound good. When somebody says, what about them? And you say they fluctuate. Right? You say, then you can add, I'm watching the Fed. You know, when the Fed thinks there's too much money chasing too few goods, inflation, what they try and do is dent or slow down demand. And they do that by raising interest rates. And that's what they've been doing to dent demand and slow down inflation. They've been raising interest rates. When interest rates go up, that should slow down the economy. Now, what they're trying to do is make sure they don't kill the economy. What they control is short-term rates. And, what happens sometimes is the Fed doesn't come in for the mythical soft landing. Sometimes by raising those short-term rates higher than long-term rates, they actually kill the economy. So 2 test questions here are about the second leading economic indicator. First, what is an inverted yield curve? It's when short-term rates are higher than long-term rates. Normal yield curve, that wouldn't be the case. And, as I said, sometimes people say the Fed, instead of taking it in for the mythical soft landing, ends up slowing down the real estate industry and the car industry, and they end up putting us into a recession. And that's our second test question. It's a negative leading economic indicator.
Short-term rates are higher than.
Yeah, no problem. So,
and is there going to be, I'd imagine there's going to be offshoots, because I feel like I just saw them in a practice.
yeah, where we're heading is this idea about monetary policy and fiscal policy. And again, 65, you do get economic questions that we're discussing right now, right? So we're talking about indicators. And I said, we really don't care on the test about lagging indicators where we've been in the business cycle, or coincident indicators where we're at in the business cycle. What everybody wants to know is what's going to happen next. And it seems like there were a lot of predictions of a recession. A lot of people thought the Fed was going to have to put us into a mild recession, 2 calendar quarters of declining GDP to slow down inflation. And they've been being able so far to do it. Right now, not a test point, the yield curve is flat. That means there's a lot of uncertainty. There's not a lot of difference between short-term interest rates and long-term interest rates. So, it's anybody's guess. In fact, the Fed has been accused of yield curve management, making sure they don't invert the yield curve because they just now want people to go, oh my God, the yield curve's inverted.
Will these questions kind of have offshoots of like yield to maturity or?
Well, bonds would be a separate issue, right? Bonds within this business sources of business information, then it would connect into where do you want to be? Do you want to be in stocks? And that's where we're heading, right?
Right.
Bonds would not, by the way, so if we're talking here, the other mission of the Fed is full employment, price stability. You definitely are going to get tested on what does not do well in an inflationary environment. Sometimes we ask you it through the back door, like, what is an inflation hedge? If your customer is concerned about purchasing power risk, guaranteed test question, we would not recommend bonds.
Right.
We would recommend common stocks. Now, there is a kind of a trick question. And what I mean by trick question is there's another thing that would keep pace with inflation. Keep pace with inflation. And that would be tips. And so the only bond, to your point, that would be okay in an inflationary environment would be Treasury inflation protected securities. So this economics discussion does lead into the investments because remember, we're doing top down. So based on our economic assumptions, then we decide which industry we should be in and then which security. Should we be in the bonds of the company or the stocks?
My question was if and this might not exist on the test, but I'm curious if like I'll be expected to use the expected return or maturity.
No, well, that's unit 20
to determine where we're at in the economic cycle.
No.
No.
So the section of the test you're asking me about, and we can look at that too, is called analytical methods.
Right.
That's unit 20 in your Kaplan material. And that's where we talk about beta and alpha and discounted cash flow and the capital asset pricing model. That entire unit is going to be 6 or 7 questions.
Right.
And it's mainly input or output. I showed up on a Zoom just like this. And the guy started the conversation by saying, Dean, I'm not paying you $225 an hour to do math with me. He said, I'm a serious math geek. You give me any two numbers, I can solve for the third. So let's just cut to the chase. Now, good news, he passed. But when he passed, he said, man, Dean, I thought I was going to, be able to roll up the score doing discounted cash flow. And I go, no. And he said, Dean, I was able to reverse engineer the formulas, but I wish I would have spent a little more flashcard time, recognition time on recognizing inputs and outputs. So I'm not going to make you do any present value, future value calculations.
Right.
I will ask you input or output, and I'll show that to you in this session as well. We'll get through the economics overview, and then we'll go to unit 20 and look some of that. All right, so we're going over economics right now. And I told you all these things are bad.
Right.
The one they're going to test you on is inflation, deflation. And again, who's supposed to make sure this doesn't happen? It's the central bank. It's the Federal Reserve Board, right? I said their two missions are price stability and, full employment. And Jerome Powell, chairman, has been saying right now we're fighting inflation, but now we're a little worried that it's time to transition to full employment. And we don't want to slow down the economy so much that we end up destroying the labor market. Right. So that's kind of where the Fed's at today. So inflation, deflation, we talked about. Cyclical industries, these are companies that deliver products and services that consumers can delay purchasing. Steel, heavy equipment, autos, right? I'm thinking I'm building an off-grid location. I need a pickup truck. And all my friends are starting to say, I thought you were going to buy a pickup truck. I say, yeah. I just, it's not a thing I got to do today, right? So these are things you can delay purchasing. The idea here is sector rotation. What I'd like to do is buy these businesses at the bottom of the cycle and sell them at the top of the cycle.
As they move with the growth.
That's right. And pretty aggressive though, right? Because if I mess up on that cycle, I'm in trouble. We have defensive industries, very testable. Defensive industries and defensive stocks. Defensive stocks are corporations that deliver products and services resilient to the business cycle. Regardless of the business cycle, you got to eat. Right. Debate on what you got to eat, but you got to eat something. Pharmaceuticals. You're sick. I'm a doctor. I tell you the drug you need is X. You're going to get it. Tobacco. I think there's going to be one guy left paying $4 billion a pack, $3 billion taxes, and $1 billion for the cigarettes. Utilities is the one they like on the test. Nobody wants to go back to the Stone Age. You might cut back on usage, but you're not going back to Stone Age. In my Las Vegas place, you can't live in Las Vegas without air conditioning. Now, you might turn it from 76 to 78 to save a couple bucks, but you're still going to be using that. So very testable. Utilities are, as common stocks go, conservative because they deliver a product, or in this case, a service that is resilient to the business cycle. We also would expect a utility company to be able, test question, to distribute a larger portion of their earnings as a dividend. We call that a dividend payout ratio. And we would expect that a mature, stable business would pay out a larger portion of its earnings as a dividend. Growth industries. Wow. NVIDIA is a serious secular growth stock. What I mean by secular growth stock is that stock has nothing to do with the business cycle. NVIDIA is an arms merchant to artificial intelligence and, language models. Wow. Right? I mean, that stock is doubling and tripling. And now the test question about a growth stock is we would expect, if we're into growth, again, this types of investments. If I'm a growth investor, I would be willing to pay a higher PE, price to earnings multiple, for a growth stock, because the assumption I have is that it will grow into the earnings. Now, I was using NVIDIA, its earnings are doubling and tripling, right, as they sell these chips, right? So that, I'd be willing to pay a higher PE ratio. I wouldn't expect NVIDIA to pay me any kind of a dividend. What I would expect NVIDIA to do is reinvest in their business, right? Come up with even bigger and better chips that cost more money and have higher margins.
Doing capital
So now
gains.
what you got to be able to do is what the test wants you to do is to be able to contrast value investing with growth. And how are they different? One difference is this idea of value investors like dividends and growth investors could care less. The only two ways you're going to make money in an investment is the income stream and or the price appreciation. If there's no income stream, the only way you're going to make money is through price appreciation. I got to think of companies like individuals. I had a young lady and, I said, listen, I know you're not going to like this conversation, but I am not a growth opportunity. There is zero growth in me. I'm already who I am. I pay dividends. That's the kind of guy I am. If you want that, and I said, that other guy's a serious growth opportunity. Gets out of jail, gets that drug thing beat. He's got nothing but upside. But, so that's the problem with you. Everything's an investment. And I go, well, I'm sorry. You got selection risk. You got to pick. You got to pick who you want. Do you want him or you want me? Counter-cyclical, very testable again about this idea of why would we want to put gold stocks into my customer's portfolio or gold mining into my customer's portfolio as an investment advisor rep. Very testable concept is under modern portfolio theory. Now, theory isn't truth. It's just a way of explaining things. And the more theory can explain, the better theory is. And what modern portfolio suggests is that if we put something into our portfolio that test question has negative correlation to other things in our portfolio, we would add additional diversification and we'd be beginning a better risk reward. And so typically gold and gold mining stocks would have negative correlation to the stock market or to financial stocks like banks, for example. So this concept of negative correlation is testable. So for example, if I have Exxon Mobil in your account, modern portfolio theory suggests that it wouldn't do me any good to put Chevron in there because for all intents and purposes, those are the same stocks. We would express that on your exam as saying +1. +1 means perfect correlation. Not everything is perfect. What modern portfolio suggests is if we put Exxon in there, maybe I put Delta Airlines in there. The assumption being that, when oil goes up, that's good for Exxon, bad for Delta. But, if oil goes down, jet fuel, that's good for Delta and bad for Exxon. So on the test, I'll say, which of the following would provide the least amount of diversification? Least, and you'd pick the one that has positive correlation, the highest positive correlation. Least, if I say which will provide the most diversification, you would pick the one that has negative correlation. And then in general, these questions about counter-cyclical, precious metals, why commodities, things that you would think would not be in a portfolio would fit part of prudent investing if they provide what we're talking about here, which is different correlation to the existing assets. Special situations. I call these story stocks. I've got a special situation for you. They're going into court. They're going to win. If they win, they're going to get a $2 billion, payment, or they're going to lose. That's a special situation. I think here maybe like a Twitter being acquired by X Holdings. I said, hey, that's a special situation. Either the buyout is going through at $54.20 in cash, or it's not. And if it doesn't go through, it's like a $30 stock. If it goes through, it's a $54 stock. That's a special situation. It's a one-time kind of event. Balance sheets. So this fits in with analytical methods. You should definitely know the classical margin or classical balance sheet equation. Now, this is testable on two levels. I say, Gabriel, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I can be in determining suitability. And you said, well, Dean, it's none of your damn business. I said, well, it is. My regulars say I should know my customer. And in the absence of suitability information, one thing I like to do, Gabriel, is do a personal balance sheet. I'd like to go over your assets, your current assets, think cash, or things you plan to turn to cash within 12 months. I'd like to go over your long-term assets, your house, your car, your retirement plans, see what your total assets are. I'd like to go over your liabilities, your current liabilities, things you intend to pay within the next 12 months. I'd like to, Gabriel, from that kind of determine how liquid do we need to be? How liquid do you need to be in your personal financial situation? So I'd like to establish your working capital. I'd like to do some balance sheet calculations with you. I'd like to establish your current ratio. I'd like to go over your long-term liabilities. Your mortgage on the house, the loan on the car. Long-term meaning something you don't plan on paying in the next 12 months. I'd like to establish your net worth. I'd like to, Gabriel, go over an income statement with you. I'd like to see what your top line is, money coming in, go over all your expenses and figure out what your bottom line is. So this applies to both corporations, which we're talking about now, as well as our customers doing this kind of analysis. As we're talking about this is fundamental analysis. And I would know the classical balance sheet equation. It's called a balance sheet because both sides balance, assets equal liabilities plus shareholder equity, or the way I think of it, assets minus liabilities equals ownership or shareholder equity. So here is a balance sheet, and let's just put a date on this because a balance sheet is a picture in time as of July 28th. And as you can see here, this company has $5 million in cash, $10 million in accounts receivable, 15 million in inventory, so 30 million in current assets. It has 20 million in buildings and furniture, 50 million in land, so fixed assets of 70 million. Now, goodwill, if we're going to be conservative in terms of doing fundamental analysis, what we're looking for is to have a margin of safety. And one of the margins of safety we have as a fundamental analysis is a valuation called book value. Book value is the theoretical liquidation value of the business. Theoretical because we don't assume we're going to do it, but par value. I'm just giving you the answers of the test. Market value and book value. And depending on what they ask you on the test would depend on what your appropriate response would be. If I ask you an arbitrary number to use to set up the company's books, that would be par value. Arbitrarily for bonds, that's 1,000. Arbitrarily for preferred stock, that's 100. By the way, that's really important to know that, because if you don't know that's 1,000, you don't know that 8% means $80 in annual interest. Right. Par for preferred is 100. Again, very important. And par value on common stock is $1. So that's par value. If I say an arbitrary number used to set up the books, we say par value. If I say a supply-demand relationship in the market, the secondary market, you would say market value. If I say the theoretical liquidation value of the business, we'd say book value. Now, if we're conservative, we're going to say the intangibles don't count in terms of liquidation. That would be the name brand. What are the golden arches worth?
Could you repeat that definition for market?
Yeah, when we do, I'm going to talk to you about book value. And what I'm saying now is that when we're talking about book value, we're not going to count the intangibles or goodwill, because the point on the intangibles and the goodwills is, what are those worth? Hard to value. Mm-hmm. That would be your brand, your reputation. When Bed Bath & Beyond went liquidated, it's Chapter 7 liquidation. Bed Bath & Beyond sold off all the assets, paid off all the liabilities, and there was negative shareholder equity. So that means the shareholders got wiped out. Right? As you can see here, in terms of liquidation, it even shows up that way on the balance sheet. Very testable. In liquidation, your creditors come first, your bondholders, then your preferred, and then your common. And I just told you there was nothing left for the common stockholders of Bed Bath & Beyond. However, Overstock.com, I thought this was clever, offered 21 million for the intellectual property of Bed Bath & Beyond. That was the goodwill. And immediately after they bought out of bankruptcy, Overstock disappeared and they rebranded it as Bed Bath & Beyond. I think there's a lot of consumers, Gabriel, who don't even know that Bed Bath & Beyond is no longer with us.
Right.
Because it lives on the internet, but that's not the Bed Bath & Beyond, right? Series 7 Guru is my social media brand. What is that worth? I was talking to my brother the other day, and he's thinking about getting into social media, and he said, well, I can't decide if I want to be Chris Tinney or when I said, I confronted that same thing, Chris, when I decided I was going on social media. I'm like, do I want to be Dean Tinney or do I want to be the Series 7 Guru? There's advantages and disadvantages. So in Dean's personal balance sheet, what is the Series 7 Guru with? I don't know. That's where I could say it's worth $1 billion, Gabriel. This depends on what day it is, right? Oh, my brand sucks. So I had a copycat guy on the internet I thought was funny. He went back to his original brand. And so he was trying to be, I'm the Series 7 Guru, and he was branding himself as Series 7 Whisperer. Yeah, I'm flattered. But then I noticed he gave it up and went back. Anyways, that's what that's about. Now we go over to the next side of the balance sheet. We got accounts payable, your employees, taxes payable, current liabilities. So test question, one of the balance sheet calculations we're held accountable for is working capital. Now, when they ask you these questions, they can ask it as a definitional question. What I mean by that is I could say current assets minus current liabilities can best be described as, and you got to come up with working capital. Or I could say a working capital can best be described as, and then I, make you shop the answer set and come up with it. Now, on a bad draw, I might even ask you to do it. Right. And so here, if we were doing the working capital for this company, we have 30 million in current assets, and we have current liabilities at 6.5.
So it doesn't include fixed assets and working
No,
capital?
current assets is cash or things we plan to turn to cash. Absolutely.
It's all short term on both sides.
That's right. Yeah, that's right.
Does it include long-term liabilities?
No. Right. So, I am building an off-grid location. So on Dean's balance sheet, I bought some land. I built a cabin. I built the studio. I built a solar array. I got contractors right now building a deck. It's probably going to be, $20,000. And so your point, I turned, let's call it, I haven't done the math yet, but let's assume I might surprise myself how much money I've spent, but let's call it 200. I think it's a low ball thing. I turned $200,000 of cash into 200 in fixed assets. That doesn't change the asset side of Dean's balance sheet, but it certainly changes my liquidity, right? Because that, my liquidity, what we're talking about here is liquidity. Basically this was started out as my brother's adventure. My brother bought some raw land out here, and he was going off grid, and he kept chatting up being off grid. And I said, Chris, I kind of like being in Las Vegas. If mom has a fall and I call 911 within, 3 minutes, I got fire trucks and police. And he was telling me how low the property taxes are. I said, because you're not paying for any civilization. There's no sheriffs, there's no fire, there's no, no infrastructure whatsoever. Anyways, my brother is not been as capable of moving the ball down the field to get off grid as I have. And, I built a solar array. Anyways, I told my brother, I said, Chris, why don't you, instead of borrowing money from a bank, borrow from the bank of Big Brother? It's open. If you borrow money from me, I'm not going to take any of your stuff. So, but I warned him, as he's borrowing money. I'm like, now remember, the bank of Big Brother doesn't have unlimited reserves. At some point, I only have so much working capital that is available, right? Today, I'm going to sell up my contractor. I think that's going to be at 20 grand. Doesn't change my asset side of my balance sheet, but it certainly changes my working capital, right? I'm going to have $20,000 less in my checking account at the end of the day than I had this morning. Now, current liabilities over here, right? It doesn't count my long-term liabilities, right? We're just talking about your liquidity. Yeah, by the way, sometimes my friends don't get this. I've had where they misinterpret. Oh, Dean, what happened? You're poor. I go, no, I'm not poor. I'm just not liquid right now. It'd be easy to fix. I could just turn one of my long-term assets into a current asset, right? Now, the other thing we want to be able to do is look at what we call the current ratio. And again, either they're going to ask you to recognize it, or they're going to ask you to do it. Now, it depends on your draw. I'm wishing for you, Gabriel, a dream draw. But I think the hardest version of these questions is kind of what you just asked me. And I don't know if your last one, if you had to face a death draw, maybe. But you asked me about fixed assets. And sometimes they don't show you a balance sheet. They just give you entries from a balance sheet. They say ABC Corporation has 5 million in cash, 10 million in accounts receivable, 15 million in inventory, has a land of 50 million, then you have to say, oh, I don't count the land. You got to toss that out. Right. So sometimes they might actually deal with it. Or they say ABC company has the following balance sheet entries, and they give you accounts payable, wages, then they give you bonds, and you go, oh, the bonds got to go out. Right. So that's what I mean by your point about does that count or not count? It certainly doesn't. Current ratio, if I ask you to actually, what is it? You would tell me current assets divided by current liabilities. And again, on a bad draw, I might actually ask you to do it. And that would mean we take the 30 million. Now, I always say, if you can't decide what to math to do, hit the divide key. If you are not dividing, you are usually doing the wrong math. So if you get stuck, take your calculator and, say, okay, I'm going to take the first number and I'm going to divide it by the second number. Now, as a corporation, we don't want to have to liquidate our inventory to pay our bills. Because if we have to liquidate our inventory, do an inventory reduction sale, we're not going to get what we'd like to get for our inventory. So another concept on the test is a concept called quick assets. Quick assets. And quick assets is the current assets less the inventory. And the idea here is we don't want to have to sell our inventory to pay our bills. So now we're just getting a more stringent definition.
Acid test, or is that the ratio?
Right on. Good job. That's exactly right. And so this is an intermediate step to do another and most stringent of our liquidity ratios. All right. So current assets minus quick assets. So in this example, we have 30 million minus 15. We have $15 million in quick assets. And the last one, the last liquidity ratio we're held accountable for, liquidity ratio, is the acid test or quick ratio. The acid test or the quick ratio. And in this, what we do, quick ratio or acid test, is we take the quick assets and divide.
It's the same ratio, just without the inventory.
That's exactly right. Because the idea is we don't want to have to sell the inventory, right? I always joke, if I'm a car dealer, some car dealers believe in turning the cars over quite a bit fast. And, if I'm a Lamborghini dealer, maybe I'm into bigger spreads, which means I'm going to be hanging on to my inventory longer, right? There's not as many people who are going to buy a Lamborghini from me. But when they do, right, I got to be liquid enough to support that, right? So this would be, in my car dealer analogy, this would be not counting the cars that I have on the lot as, part of this calculation. I always joke, if I get less than 1-to-1 on my current ratio, it means I better get my butt in gear because I'm going to have a liquidity crisis, right?
I think of that as acid would melt.
There you go.
I like things, so it takes away the
inventory. I like it. That's exactly right. I was joking with my brother when I was talking about the bank and my brother. I said, Chris, if you don't owe anybody any money, you can't go bankrupt. He goes, I never thought of that. I go, yeah. I mean, if I don't owe anybody any money, I was joking about my paying cash for all this stuff, but The good news about paying cash is I don't owe anybody any money. So I can sit here on my butt if I want and smoke my cigars and drink my scotch. And, who cares, right? All right. So one more balance sheet thing. There's no such thing as a corporation that isn't capitalized with common stock. So if I go to see an attorney about different types of business structures, he says, Dean, what do you plan on doing? I was in a collaboration with a corporation, and their legal department said, Dean, we cannot collaborate with a living, breathing human being, a natural person walking planet Earth. We need, on the other side of this transaction collaboration, an unnatural person, not a living, breathing human being. We need a S corp or a C corp or an LLC if we're going to be doing business. So I'm going to have to set up a business structure. Now, good news for me, Gabriel, it's not my first rodeo. So I know when I call my attorney what I'm going to be doing. Anyways, they were a little concerned that this collaboration might turn into a competition. And so they said, well, Dean, we want to make sure that, we don't end up feeding a future competitor. I said, well, you can tell by the capital structure that I set up to come back. When I come back, if I come back as a C corp, you should be concerned, because that means Dean has issued common stock. I have stockholders. I can issue preferred. I can issue bonds. That means I have visions of grandeur. If I come back, which I'm going to as an LLC, that means I just want to pass through the money. I don't really want to, take on the world. I just want my money. So if we're going to have a capitalized, raise a lot of money, we're typically going to set up a C corp, because the C corp is the easiest way to raise large amounts of money. And we're going to capitalize that with equity and debt. What does that mean in plain English? Is we're going to capitalize with stocks and bonds. I think a good analogy here would be your house. I say, Gabriel, how did you capitalize the purchase of your house? What do you mean? I said, well, how much equity did you put up and how much of a mortgage do you have? It's neither good nor bad.
Right.
Just a decision about how leveraged you want to be or not. So as we see here, we have issued here common stock, par, 10 million shares of common stock, par value being $1. We have raised originally $15 million from the common stock. I wouldn't worry about that. It's capital paid in surplus, but we raised 15.5 in capital originally when we, set up this business structure. We issued $20 million in preferred stock. That's a total of 35. And then we didn't distribute as earnings. We kept 18 million. So here we
capital in excess of par.
Capital in excess of par is what we sold the stock for in the initial public offering past the par value. So here par value is $1. We raised 10. That means we sold 10 million shares at $1. Well, I'll just do it right here. Not testable, but that would be 15.5. So I'm taking my calculator. I'm going to show you what that
What
is.
it was actually sold for.
Yeah, 15.5 divide by the million shares. How do I know a million? Because par value is $1, right? So, 10 million shares, excuse me.
Yeah.
So we issued 10 million shares. So we have 15.5. And I'm going to divide that by the 10 million shares. There we go. Boom. And we originally sold this stock for $1.55 a share. $1.55 a share. So that 55 cents is what we call excess of par. So what we're trying to figure out here, Gabriel, is how much money is in the business. And so here, what we're going to do is take our shareholder equity, total net worth, and we're going to add to that the bond money, which is 40 million. And that gives us our total capitalization, 53.5 plus. Now, we're not talking here about liquidity. Here, we're talking about capitalization. We're talking about solvency. And so here, the total capital is, and by the way, and if you're going to compete with a business, we're doing it at valuations. And I say, you wouldn't want to compete like a Toys R Us, for example, Gabriel. I'd be the first person to admit that selling toys in physical locations in competition with Amazon and Walmart is difficult. But, it doesn't help that they got billions of dollars of debt on their balance sheet, which means they got to sell a lot more toys, right? So, I mean, here in my that example now, we have total capitalization here, 53.5 plus the 40 million, 53.5. Boom, times the 40, that's 93.5 in total capital.
What do you subtract from there?
I'm not subtracting anything. I'm figuring out how much money is involved in running this business. And I'm taking the bond money. We capitalize the business through the issuance of bonds. And we have 53 million that came into this company as equity.
Okay.
I haven't subtracted anything. I'm adding,
You didn't include.
I'm adding how much is involved from our stock, our owners, and how much is involved in the debt. And so that's our total capital right there. Now the last balance sheet equation you're held accountable for is debt to total capital. We want to figure out of how much of the money is involved in running this business, how much belongs to bondholders versus how much belongs to the owners. And so now I do this, and now I find out what debt to total capitalization is. And again, this is just how leveraged is the company. So I'll just do it 40 million divided by 93.5. And we find out, 42 cents or 43 cents if I round up belongs to bondholders. 43 cents of every dollar belongs to bondholders. Now, the point of this is, how much financial flexibility do we have in this business? What I mean by that, Gabriel, is that if we have here 43 cents, kind of counterintuitive, but some companies have a large amount of debt on their balance sheet and a small amount of equity on their balance sheet. And we say they trade on equity, meaning counterintuitively, they have a small amount of equity and large amount of debt. So, for example, utilities balance sheets have a large amount of debt on a utility company's balance sheet and a small amount of equity. And again, this is about the solvency, not liquidity. So if we're testing you for solvency, again, my home analogy, right? You say, Dean, if my home's value, 95% was financed with a mortgage. And I say, Gabriel, I live in the house next door and my capitalization is 50%. I put down 50 and I loan borrowed 50. I'm more solvent than you are. That's not a good nor bad thing. It's just, again, deciding how you're going to finance something. But I would say we're more aggressive in fundamental analysis when we're looking at this thing called it. Now, as I said, if we wanted to figure out the book value here, we would take the assets, not counting the intangibles. So that would be 100 million minus 5, 95 million. We would subtract the liabilities. We'd pay back the preferred stockholders. And then we would divide by the million shares. That would give us book value per share. I'm not going to make you crunch it. I'm just saying it's a valuation technique. And if I'm a value investor, I'd like to have a market price close to the book price. I was reading about Citibank. This is embarrassing. JP Morgan trades at 1.2 book. So that means the book value of JP Morgan times 1.2 equals the market price. And Bank of America trades at 1.2 times book. Book value times 1.2 is the market value. Citibank trades at 0.60 of book value. That's embarrassing. That means Citibank is worth more dead than it is alive. And the fundamental analyst I saw being invested said, the CEO, if she can just get the book value to 0.80 from 0.60, that would be relate to a market price of. And he was saying, and therefore, I think Citibank is undervalued. Yeah, we all know it's not best in class, That's not Jamie Dimon over there. That's not Brian Monahan over there. But hey, we can get it for 60% a book. Now, by the way, the CEO saying she's selling off assets, non-productive assets, to reinvest in the bank. And I said, okay, well, cool, right? She's selling the Mexican operations, and Citibank for years used to be an international bank. And she's saying, well, maybe not so much. So that would not be a
Would it,
growth investor. That would be a value investor would be interested in that scenario.
right. Would it be correct to say that essentially all these ratios are only using current assets, and the only thing that includes long-term
Yeah, I like
would be capitalization formulas?
I do. I like it. In fact, I'll just go further. I told you that 3 of those things, I call this the Sesame Street trick. And the Sesame Street trick is testable.
Mhm.
So you nailed it. Working capital, current ratio, quick ratio. A, working capital. B, current ratio. C, quick ratio. All deal with liquidity, current assets, current liabilities. The way I could say that on the test is all of the following are about liquidity, except, right? You just brought up, how is that last one different? The last one doesn't deal with the current assets, right? Debt to total capital does not deal with liquidity. Do you remember what I said that was about? That was about solvency.
Right.
And, solvency is different than liquidity. Solvency means to say Dean is not liquid. Let's say, Gabriel, I'm sitting on $70,000 in cash. And so I pay the contractor, 70,000. That means I got 0 liquidity. Are we good? It doesn't mean Dean's bankrupt. It just means I have no cash. That's different than if I tell you that my contractor says, Dean, you owe me 80,000, and I go no long-term assets. That means I'm upside down 10. That means I'm not solvent. I'm bankrupt. Right? Those are different things. So your point, you're on the right track. This is liquidity, working capital. This is liquidity, current ratio. This is liquidity, acid test. You nailed that earlier. Of the ones, that's the most stringent. And that last one is about solvency. So, they love to do the accept format on the test. Now we're doing fundamental analysis. We're doing fundamental analysis, and that means financial statements. And, if it's a publicly held company, we're going to get 3 10Qs. This is for, it looks like the third quarter here. We're going to get a 10K. That's the annual results in the fourth quarter. And again, we might be looking for this as an investment advisor rep. When I was a practitioner, I said, Gabriel, I'm with you. This is one of the portfolio positions that right now there's a lot of uncertainty. I'm not sure we should pull the trigger and sell it. What I like, Gabriel, is to see the next quarter's results and make our decision after that. Let's get some more data points here to look at. I'm not sure. Let's look at the revenue and see if it's holding up or not. That's your top line.
The my income statement is always it's an annual figure. It just always gives its time period.
Yeah. Oh, right. We get very test. We have 3 10Qs. So we always are going to be doing on a corporation. We do it every quarter. And then the fourth quarter is combined with the 10K. So we get the fourth quarter separately. And then we get the annualized result in that 10K. That's the annual report. This is on your test called sources of financial information. And one source of financial information is 10Qs and a 10K. Another one I'll just add to the mix is an 8K. And that's where public companies' current event. What I mean by current event is their CEO resigns, or they have a litigation. Oh, here we go. CrowdStrike. Oh my God, how embarrassing. Listen, my friend, within 4 days, he better get out of 8K telling the CrowdStrike shareholders, hey, we got problems, Gabriel. Now, I understand the guy, from what I know, I doesn't mean Dean wants to buy his stock, God knows. But the guy used to be a crisis manager for McAfee before he started CrowdStrike. And I thought this was kind of I thought as a CEO, I mean, listen, I'm still pissed off if my systems are down in SIM, but he said to his team, get me on Today show. I need to go on the morning news right now, tell people what happened and what we're doing to fix it. And I go, well, okay. He's not sitting around on his butt waiting. That's called an AK, and that has to be filed within 4 days. Right. So goodbye, Silicon Valley Bank. Silicon Valley Bank filed an 8K saying they had a $2 billion loss in their mortgage portfolio. I personally, Gabriel, think their AK triggered the run on the bank. I think when fundamental people looked at that AK and said, what? And poof.
Would it be, let me see here. Is it a better memory tool to figure out? Because I'm looking at a lot of terms that are not.
Oh, I don't think so. Here, I'm just going down to the bottom. Let me just tell you what's important. I don't think there's a lot of things on this income statement we need to be worried about, except I do want to point out a couple things. We need to know, not so much from the income statement, but make sure you understand here, the preferred stock has preferential treatment in 2 areas. On the balance sheet, we could see this. If we go back to that balance sheet, please note the preferred comes ahead of the common.
Right.
In liquidation and in dividends. And so second point, we say we have net income. Now we have earnings available to common. I am not going to ask you to do earnings per share or any of that. But I will ask you to recognize this idea of paying the dividend. And the company here, I think, is being pretty stingy as a dividend payout ratio. I mean, if we took the $1 million in dividends and we divide, by the way, you can't decide what to do, divide, that dividend is abysmal. So, this is probably a growth company because they're saying we're going to keep 33,200,000 to build the business. We're only going to distribute to the owners $1 million. I thought this was this was a new CEO. And when he took over, he said, listen, before I agreed to be the CEO, we need to change our dividend payout ratio. It's way too high. I'm not going to come over here to be a steward of this business and just distribute all the earnings to the shareholders. That's what you've been doing. I want to build the business. So if you hire me, moving forward, the dividend payout ratio is going to be 50%. I think that's fair to shareholders. If we make 34.2, 16, whatever to the shareholders, $4 a share, we pay out $2. I think that's important. And remember, we said we do get tested on identifying a company's either growth, no or low dividends. So we think this is a growth company or a mature, stable business because it pays that dividend. All right, so that's fundamental analysis. We talked about economic theories. There is one you're held accountable for. And the famous economist that you get tested on is Lord John Maynard Keynes. And Mr. Keynes said that when the business cycle is weak, one of the reasons it's weak is because there's no demand. And so the government should step in and step on the accelerator called government spending to stimulate demand. Right. And that's, prior to Mr. Keynes, we would say, in the long run, it will fix itself. Mr. Keynes said, in the long run, we're all dead. And so here, under demand side, government intervention in the economy is seen as a positive kind of a thing. Now, one of my favorite economists, a guy named Lawrence Summers, is a Democratic economist. He thought fiscal policy, test question, government spending and taxation, that last stimulus check out of COVID, he thinks what's triggered that inflationary spiral. So the government accidentally created too much demand. President Trump sent me the check. I thought, well, gee, thanks. I don't really need the check, but, thanks, right? The government was trying to make sure that the demand didn't collapse during COVID. When we came out of COVID, now onward, upward. Now, there's other people who think, well, gee, the government shouldn't do this. The government should try and set up a business environment that would promote businesses making these asset allocations. So, every thesis has the antithesis. So, demand side, government spending, supply side, reduce taxes, people have more to spend. And again, those are two popular ones. Now, I am a U.S. importer. I import blue sapphires from Thailand, Swiss watches, tequila, Scotch from Isla. And so Dean loves a strong dollar because as a U.S. importer, it means I can buy more stuff. So if I'm a U.S. importer, that's going to be good news for me, a strong dollar. This is testable. And so when the dollar's strong, Americans are going to buy more stuff. And then I was tutoring somebody for 65, and she said that her friend is the CEO of Caterpillar. I go, wow, that's exciting. And I said, well, he's got the opposite problem with Dean. I import tequila. So when the peso goes from 10 pesos to 20 pesos, that's great for Dean because my $80 bottle of high-end tequila is now a $40 bottle of tequila. Ooh. And I said, but, AMLO, who's the former presidente of Mexico, he's got all kinds of infrastructure projects. And, he's buying all kinds of Caterpillar excavators and rock trucks and bulldozers. And, God bless him. But the problem for my guy at Caterpillar is he's going to have to charge our Mexican friends twice as much, right? If 10 pesos used to get a buck, and now it takes 20 pesos to get a buck, if he wants the same dollars coming back, he's got to double his prices. And that would be difficult. That's the test question for U.S. exporters. One more point. This is tied to interest rates. Because when interest rates go up, the dollar becomes stronger. It becomes more attractive for people. Right. And so, as I mentioned, as the dollar gets strong, that means, that's good for U.S. importers, again, bad. That's tied to, on your test, interest rates. High U.S. interest rates mean a stronger dollar. Low U.S. interest rates mean a weaker dollar. Okay, so now the dollar is weak. So now this isn't going to be bueno for Dean, right? The peso last time I checked in the spot market, Gabriel, that's the current exchange rate. The peso was 17. Let's just say it goes all the way back to 10. Well, that kind of sucks because my $40 tequila goes back to 80. And that means Dean's not going to buy as much tequila, right? So cost of imports increases, making them less competitive. I probably drink too much, Gabriel, because, my single malt scotch is called Lagavulin. And, I went over to the bartender, I ordered a Maker's Mark, and he goes, Dean, are you okay? And then he looked at me and I said, well, I'm doing what I can do to help the trade deficit. He goes, what do you mean? I said, yeah, I'm helping the trade deficit because I'm buying a domestic whiskey. I said, have you seen the exchange rate with the British pound? My Lagavulin cost me, way more than it used to. So, he goes, are you serious? I go, well, kind of, kind of serious. I mean, I could order the Lagavulin if I wanted. So here the imports decrease, cost of U.S. exports decrease. So this would be good, right? The peso goes back to 10. The guy at Caterpillar has now a D8 that costs half as much. Now on the test.
So what's something that's throwing me off fundamentally here? Because when I see the word costs, my brain doesn't make the connection with who costs to who.
Oh, the exchange rate. Oh, the test is so egocentric. The test assumes the whole world revolves around U.S. Things. Okay. So I think when we think of costs, I would think of exchange rate. What this really should say is exchange rate. And so when the U.S. dollar strengthens, that again, your point, Gabriel, that is a that's right. It's a meaningless discussion unless I tell you in relationship to what currency.
Right.
Right. So that's it. You say, Dean, the dollar is strong. Well, in relationship to what? The Kwanzaa, the baht, the yuan, whatever the case may be. Now, the test is I told you, kind of prejudicial. And what I mean by being prejudicial, Gabriel, is I just told you I'm a U.S. importer. So for me, I like a strong dollar. But on the test, the strong dollar is considered to be bad because it contributes to a trade deficit. Right. And on the test, they want us to say that this is bad.
Importing more.
Right. That's
right. They're importing more than they're exporting. And
that's right. And this is good. I think that's kind of a oversimplified version of trade. But, hey, 65, we take what they give us. Okay. So we wanted to get economics done. This is about 8, 9 questions, maybe more, depending on when it bleeds into You were thinking about investments.
I kept getting questions about business cycle indicators, about using cycle indicators to determine where we were at in the business cycle, peak, expansion, trough. I've gotten
Yeah.
every one of those wrong.
That, and I gave you two of those.
Okay.
And then we said that you get tested on tools of the Fed.
Yeah.
Right. And how they control
Good
the
with
money.
tools. I'm pretty good with tools of the Fed.
Good,
Prime
good.
rate, no. Discount rate is set by the Fed. Prime rate is
Yeah,
banked
let's
by
try
the
some
Fed.
questions. Our session's kind of over. We didn't get to, we can book another session you like, but we didn't get to discounted cash flow, capital asset pricing model, present value, future value. And we can certainly do that if you'd like in the next session. But let's do these to finish off. Let's
Yeah.
have you demonstrate your prowess or lack thereof in some practice questions. All the following are associated with economic expansion, except.
Okay. So looking for the odd man out.
That's right. That's exactly what we're trying to
So
do.
expansion looks like increasing GDP sounds right. Higher stock prices sounds right.
Mhm.
Rising consumer debt sounds wrong, but I'm not sure. And more.
Yeah, you're right. That's it. That's the wrong one, right? That means we're probably looking your point earlier about a peak, right? Consumers are running out of money as that goes up, right? We might end into a situation with that. Now, did you tell me you have any paid supplements in your
Yeah, I have Kaplan.
do you have any, do you have Teskey?
No, I don't have Teskey.
Okay, so I'm going to send you complimentary. My buddy Brian Lee of Teskey, two things that are really important. I think in your notes you said something about memory stuff. He's got a nice PDF that I'm sending you. It has a nice overview of the test concepts. And then the most importantly, what it has is a practice test that is spot on. It has very strong correlation to the actual exam. So I want you to do that 2 days out to get a final mark to see where you're at. Put it away. Don't do it right away because it'll be a nice check. It'll be something different than Kaplan for
Right.
you to try to get a
Yeah,
game.
I keep seeing so many silly
Yeah,
Kaplan
yeah.
questions.
So I'll send that to you.
Thanks.
Fiscal policy includes very testable.
Let's see. Okay, so that is always need my pen and paper. Increasing taxes to control the economy. No. Lowering taxes. No. Increasing. No. Fiscal. Fiscal. That is not money policy. Fiscal.
That's exactly right.
Policy. Fiscal policy.
So it's
Money
government
policy.
spending and taxation. It's controlled by Congress and the president. Very testable.
Fiscal. So that's all of it, really, or no, it's not.
Well, no, some of them are mutually exclusive. You
Fiscal.
can't tell me that.
Oh, I see. Okay. So that's all right. 1 and 3. A.
Yeah, job. Right. This is very much an answer set. Every one of these are testable. So I'm not as concerned about getting this question right as I am that you know each and every one of those interest rates, where the money is coming from, where the money is going to.
Okay.
This says which of the following is set by the Federal Reserve Board, and you say
discount rate. See,
right on. Let's just do the others.
Yeah.
Which of these rates is the most volatile?
Oh.
Changes the most often. Fed funds.
Federal funds.
Fed funds, right? Most volatile.
Most
Which of these is banks with excess reserves lending to banks with deficient reserves?
B.
A. Fed funds. Fed funds is banks with excess reserves lending to banks with deficient reserves, and it's most volatile. Chance to redeem yourself. Which of these rates is the rate charged by a commercial bank to its best corporate customers?
B.
There you go. Which of these is used to finance margin accounts at a brokerage?
D.
D is in dog, right? Broker call. All right, pretty good. I think that was a good session. We didn't get everything done I'd like to have got done with you, but we got done a lot. Anything else for today's session? I'm going to send you the supplement. Please make sure you look over that supplement. And like I say, make sure,